So by now we have a pretty good idea that the costs of credit booms go and bust provide a very clear rationale for financial stability policies. However, there's a very strong ongoing debate still about which precise policy works best to dampen an unhealthy credit boom. So essentially, there are two types of policy options on the table. On the one hand, there is a sort of sledgehammer option, which refers to conventional monetary policies, so a sort of uniform rate hike that affects everybody in the economy. And on the other hand, there is the sort of scalpel option that groups more targeted policies, such as macroprudential policies. Now, one reason why there is this ongoing debate between these two policy options is that there is a lack of empirical evidence on the comparative effects of these two options. And this is due to identification challenges. So first of all, of course, policies are usually endogenous to what's going on in the economy. Second, it's very hard to differentiate credit supply from credit demand responses to the policies. And thirdly, and that's perhaps the most important point here, the two policies or policy options are usually considered substitutes rather than complements. So it's very hard to run a horse race fixing time and environment to get at the comparative effects. Now, what I do in this paper is essentially I use a natural experiment to overcome these identification challenges, and more specifically, I draw on policy variation across Federal Reserve districts in 1920-21. So that's at a time when the different Federal Reserve districts still had some power to conduct different monetary policies. And what happened at the time, so in 1920, is that in reaction to a strong price and credit boom, four of the Federal Reserve districts hiked their interest rate from 6 to 7%. Those are the ones that are here in yellow on this map. And then another 4 districts actually used targeted monetary policy. So they did not implement a uniform rate hike and kept the base rate at 6%, but targeted higher rates at over-leveraged banks. And then finally, there was another group, a third group of districts which did not change policy. Those are here in green. So obviously, these policies were endogenous to what was ongoing at the district level. And so the question is, how can we exploit these policy changes in a setting to get at the causal effects? Well, what I do is I basically exploit policy border discontinuities with bank level data in a local way, so in very small bandwidths around the policy borders. And within these bandwidths, I can show that baseline covariates on the local economy and on the financial system locally, as well as pre-trends, are actually statistically identical essentially. So I can use a local difference specification to get at the effects of the policies. What is also nice is that my sample includes exclusively national banks. So these were uniformly regulated at the time and supervised. So there are no other spurious discontinuities across policy borders induced by supervision, for example. And finally, the setting also only allows for very limited cross-border possibilities for policy arbitrage, and that's also helpful. That's because national banks were generally not allowed to branch, and because they were not allowed to cross-borrow from another Federal Reserve bank in another district. Finally, what I can also show with my data is that the banks did not sort in reaction or in anticipation to the policies, and that the Federal Reserve bank districts, and that's an insight from the literature essentially, they were designed in a way to fence in local interbank links. So this already prevents a large part of what policy arbitrage could usually be going on in that kind of setting. Now, what are the main results that I find? So I use 2 outcome variables. On the one hand, total lending, on the other hand, the leverage ratio at the bank level. Here in this picture, you only see the results for total lending. And what I find is that targeted monetary policy actually reduced credit growth between 5 and 10 percentage points, whereas the uniform rate hike seems to have had counterproductive effects, actually. So this kind of policy increased credit growth between 2 and 6%. Now, I'm going to talk about the mechanisms behind this in a while. But before I do that, let me talk a little bit about the origins of the policy variation that is at the core of this paper. Now, what is really important is that so there was a first wave of policy changes in the beginning of 1920 in January, where all districts across the entire territory of the United States raised their rates to 6%, and that was basically to protect the gold reserves of the financial system of the Federal Reserve System. However, there was a second wave, and that's the one that is really at the center of this paper, a second wave of policy changes that was clearly motivated by financial stability concerns. And what happened there was that, 4 districts, districts 1, 2, 7, and 9, hiked their interest rates to 7% from 6, so by 100 basis points, as I said before. And they did so, and they did this in a uniform way because they were concerned that the whole banking sector in the district was over-leveraged. Now, there was another group of 4 districts that I've shown you before already, so districts 6, 8, 10, and 11, who used targeted monetary policy instead. They did not want to raise the rate for everybody in the district. So, and this was because there were quite heterogeneous policy banking developments in these districts. So some banks were greatly leveraged, others were not, and so these districts actually opted for a targeted policy. And the way they did this was essentially by lobbying Congress to pass a new act, the US Phelan Act of 1920, that introduced the possibility for Federal Reserve banks to implement the progressive discount rate scheme. So what this meant is that Federal Reserve banks who opted to adopt this kind of policy, first of all, actually they computed a so-called basic line for each and every member bank in the district. And this basic line is sort of a maximum credit line, if you will. And this maximum credit line was a function of a member bank's reserves, its capital, and its surplus. So borrowing up to that basic line from the Federal Reserve Bank was possible at the flat 6% rate that was prevailing everywhere. But borrowing in excess of that basic line from the Federal Reserve Bank was actually penalized by the Federal Reserve Bank, which adopted the policy. Namely, for every 25% you borrowed in excess of your basic line as a bank, you got charged 50 basis points in addition to the 6% rate. Now, the data that I'm using for this paper is depicted here. Essentially, I use OCC reports on the Rand McNally Bankers Directory, and I had collected about 12,000 bank balance sheets and a lot more interbank links. And what I do is I focus on the East Coast and the midden states of the United States, because there I can find all the sort of policy borders that I'm interested in, including placebo borders, as you can see here, between districts which actually had the same kind of policy, like the ones that are depicted here in green. I use these data and other data in addition to that to test for local continuity, and also, for sorting and the kind of usual tests that you do. Something that I want to mention here, though, so I'm not going to go into detail with regard to the test because of time constraints, but what I want to mention here in detail is that what is important is that the treatment intensity of the two policies was relatively comparable, and that's obviously important for the purposes of this paper. So the average rate paid by treated banks in the PDR districts was about 7% actually. So 6.76, so relatively similar to the uniform rate hike. Now, the results that I showed you before are really robust to a series of placebo checks and other kind of specifications that I'm also not having the time to go into, but I refer you to the paper for them. The only thing that I want to mention is that I also focus my study on split states in a robustness check, and these are states that were split by Federal Reserve districts, so they had different policies within a single state, and so that allows me to rule out that my results are driven by spurious discontinuities in economic policies across state borders. Right, so now the rest of the time I want to focus on the mechanism actually that drives these results. So first of all, I wanna highlight or emphasize that basically the estimated treatment effect that I find is sort of a net effect of two effects, of a contractionary reserves channel and a counterproductive risk shifting channel that's going on. And so what's happening is that in the targeted monetary policy case, the contractionary reserves channel prevails, whereas in the uniform rate hike, you have the counterproductive risk shifting channel that sort of is stronger. Now, to understand how the contractionary channel worked at the time in the United States, it's useful to focus on this picture here. So what happens if a member bank actually granted a loan to someone in the local economy is that it usually created a deposit. And for these deposits, it had to hold required reserves with its Federal Reserve Bank. To get these required reserves, it usually borrowed from its local reserve bank. And it did so at the cost I, so that's the nominal interest rate essentially. And now that's where the two policies come in essentially. So the uniform rate hike, what it did is it led to a flat increase of this cost of marginal reserves by 100 basis points, no matter how much you borrowed. And the targeted tool, the progressive discount rate, actually made this cost a function of how leveraged you were already when you started to borrow or when you needed to borrow. So what the targeted tool, the progressive discount rate, actually meant is that it allowed the bank to the Federal Reserve Bank to price discriminate against over-leveraged banks. And that's why the contractionary channel was so strong there. Now, focusing on the counterproductive mechanism, what I show in the paper is that the counterproductive effects actually concentrated in one specific district, namely in the New York district. So that's the second district. And in the paper, I showed that banks that were located in the New York district had a higher reliance on deposit funding than the Chicago district. So the funding shock of the uniform rate hike was stronger there. In addition, the New York state usury rates did not allow the member banks located in the New York district to pass on the interest rates or the higher interest rates to the local customers because the usury rates were binding there, whereas they were not binding in the Chicago district where they were 8%. So that's something that you can see also in this graph here. So these two things combined reduced the skin in the game of member banks in the New York district. And together with stronger interbank ties to New York City, it allowed to raise additional funds. It allowed them to gamble for survival and resist deleveraging in reaction to the uniform rate hike. So what I show here econometrically in this table is that when you interact the treatment effect or the treatment indicator with an indicator for banks that have a high deposit base or that have many or more New York City correspondents, what you find is that the pure treatment effect actually looks very, very much similar then to what you see for the targeted monetary policy. It becomes negative and also statistically significant. So these two factors that I mentioned actually, capture these counterproductive effects. And now let me briefly summarize. I hope I'm in time, roughly. Let me briefly summarize this paper, this presentation that I gave to you. So essentially I use history in a couple of ways in this paper. So first of all, as a laboratory. So I use it to run a real horse race fixing time and environment between two policies that we usually cannot test in terms of comparative effects in a modern setting. And they have comparable average treatment intensity as well in this historical setting. So that's important. Second, I use it, also to showcase how important context is for these kind of financial stability policies, even today, in order to understand what kind of effect they have. So, in my case, it's a contractionary bank lending channel and a risk shifting incentive. And it's important to understand these in order to get a better understanding of what drives the treatment effects that I find. Finally, it's a source of inspiration as well. Because the kind of targeted monetary policy, so history is also a source of inspiration here because the kind of targeted monetary policy in my paper that was used at the time is a sort of middle ground between a uniform rate hike as it would be used today and macroprudential policies. And if you ask yourself whether price discrimination by a central bank is something that, you know, would never be done today, then I would only refer you to what the ECB is currently doing with the TLTROs, where they also have different interest rates actually for different banks, for differently performing banks. So that's pretty much it from my side. So there is also the point that the Fed likely amplified the effects for the 1920-21 depression, but I'm not gonna go into detail here because I don't have the time here. But thanks a lot, and I'm passing the baton to Helim now.
Okay, so okay, so okay.
Can you guys see it?
Yep. Yep.
Yeah.
Good.
Good. Okay, we are good to go. So thanks for letting me discuss this paper. I learned a lot. And yeah, since given the time limit, I will just go right into it. So overall comments and summary, I think overall comments, I think Kilian can rewrite a little bit and then make it like more relevant for like what's going to happen today. So what's happening at the time was that there was a large inflation concern at the time. So the Fed had to increase rates because of inflation is bad. And that's what's going to happen now. And given that, you know, the Nasdaq just fell by 4% because now the Fed is now going to say that it's going to raise rates. So given what's going on now, we know that the Fed is going to implement contractionary monetary policy coming in 3 months. So given that we are going to have contractionary monetary policy, and it's going to have a large effect. One way we have to think about is what is the best way for us to implement contractionary monetary policy. So right now, we are just thinking about discount rate, and which is a uniform across all the banks, but maybe we can make it in a way that's more micro-prudential, and it's targeting each bank at a different level, since we want to kind of like progressive tax rate, where each individual is under different tax rate, and then we pay different taxes based on our income bracket. So now what he found is that member banks are located in districts with tight monetary policy contracted more than member banks located in more lenient policies, and when borrowing constraints were imposed at the bank specific level, which means a progressive policy, the effect was larger. And I'm not going to go through. So what he does is that he looks at borders where policies were implemented at different level, and then he's comparing dip in dip. He's essentially doing dip in dip. So since Kilian did it, I'm not going to go through. So these are the Fed boundary districts, and these are the policies that were implemented. So here, I think it's important for us to understand assumptions. So assumption here is that when these Fed policies are implemented, you know, it's on the liability side, it's going to be reported as short-term borrowing, and then it's rediscount. So since you are essentially trying to shrink short-term borrowing, your assumption is that banks cannot increase equity and so equity is not an alternative source of finance. And then your assumption is that rates are binding. So any additional borrowing is not profitable enough for them. So if even the rates are very, very high, if you can charge a high high rates on lending loans, you will still borrow. So you have to meet this assumption that it doesn't really matter how high rates are. If you can make profits, they will still borrow. And third, it has to be the case that deposits, you cannot raise deposits locally. So their local deposits alternative, there's no alternative source of funding. So Kilian is talking about it, but in order for his identification to work, these three assumptions have to meet. But you also have to think about these additional considerations, because borrowing is an endogenous decision by bank. So it's not that all banks were borrowing. Some banks were borrowing and some banks were not borrowing. And then depending on their conditions, there was a large degree variation in the level of borrowing. And the most important fact is that in early 1920s, there was already a rate hike, which means that all banks that were borrowing were already treated. So whatever you are doing at the later stage of this exercise, you are doing that were already treated, and at the marginal level, they are willing to go for higher rates. So the problem here in that case is that in this case, what he can observe is not, he can directly observe what's being affected, which is short-term borrowing. But you know, I think what I suggest him to do is that when you go to the Fed OCC reports or Federal Reserve Bulletin, there is an aggregate level for each district, and then you should apply short-term borrowing by district and by state, which I have data, and then see how they move around this period. And you have to know that banks are borrowing because they didn't have enough cash assets, liquid assets. If you have liquid assets, you would just draw down liquid assets, not borrow. And from my own research, it's a very kind of preliminary. What I found is that banks with high reliance on interbank borrowing are the ones that reduced bank lending. So there's a lot of dependence. There's a high link between dependence of interbank borrowing and lending. So what I'm saying is that given that there's a high dependence between lending and borrowing, these ratios, you can create different groups and then put them in a bin, and then you can investigate further how or what these relationships are. And second one, what I suggest is that in your research, what you want to say is that which one is better? Is it better to have a uniform hike, or is it better to have progressive? So, and there is one place like right here, like I always have to have a map that happened all at the same time. So study these three stages together, then you can have a better idea of, okay, like, this is what happened. I studied all of them together. And interbank borrowing. So Kilian talks a lot in his paper. Kilian talks a lot about interbank borrowing or interbank network. And part of it is because we don't really know much. I mean, although many people have worked on it, we still have a very limited understanding of the interbank system. And in my recent work, I've gained a lot more knowledge about this interbank system myself. And when you look at the interbank network, there are two functions. One's the payment function, which is the interbank deposits. And the other one's the funding role, which is that you are borrowing. So if you are a Fed, you would borrow from the Fed or other banks. If you're a non-member, you mainly borrow from the member bank. So in my recent work in Virginia, I actually mapped those banks, two types of relationships together. And what's a problem with Rand McNally is that Rand McNally just sets interbank relationship, and it's a deposit relationship, not funding relationship. So when you look, this is one example. It's a Virginia bank, and this bank had 5 banks. And then if you look at Rand McNally, you will see 5 names. But then these are all deposits, and this bank only actually borrowed from one bank, Lynchburg National Bank, and it was the counterparty that actually lent this bank fund, short-term funds. So it's not the same. So the Rand McNally didn't report borrowing relationship; it's the payment relationship. So why do I say this? Because I think you are too concerned about interbank relationship, and short-term borrowing was composed of rediscount and bills payable. And in my study, I studied non-member banks, and most of that was bills payable because they were borrowing from member banks, and then liquidity was being passed through. But then you are studying national banks, and if you look at national banks, they're most rediscounts. So if this is short borrowing, which is bills payable and rediscounts, and this is rediscounts, and you can see that most of that was rediscounts. So the borrowing from other banks would have been very, very small. And then I don't think it would have been a concern for you. And then I would just mention this and then move it to the appendix and then focus on these other things. And then another thing I want to mention is the interbank borrowing was very, very local. So they were just in Virginia, for instance, they were just borrowing from other Virginia banks or Richmond. So from New York, they were borrowing like 8%. It was very local. So I don't think you should be concerned about having relationships with like New York and others. And lastly, read Killian's paper. Killian is focusing just on national banks because whenever you're studying lending, one of the biggest challenges is to control for local economic conditions. And one way to do it is you get to tight border studies. So you just make sure that they are similar. And another thing is that Killian says in the paper that he actually has balance sheets for all state banks. Then Killian can actually use state banks as controls or local economic controls, and then use the entire state. So in his case, in Killian's case, Killian has Kentucky and New Jersey. And then if he has all the state banks for these banks, he can basically do dip in dip and use the split. So I'm not sure, I don't know much about state banks, but if there were no major regulatory changes, then you can difference out differences between these, and then the difference and difference estimator will get the effect of monetary policy. Then you have a larger sample, and then if you want to put banks in a different category, it will allow you to do that. So conclusion, how should central banks implement tight monetary policy? And important policy implications can come out of this research. And another thing, Killian is actually talking a lot about financial stabilization policies, but in UK, they're actually implementing bank-specific capital requirements. And then, they found that it was very effective. So if anything, I think Killian should cite these papers. And, we can think about, how we can improve monetary policy. I enjoyed reading this paper, and thanks for letting me discuss this paper. Thank you.
So I think that was both of you were terrific. Maybe take a minute, Killian, and maybe if you could respond to Hailim, and then I have a couple of questions.
Okay, I'll be very brief because I really enjoyed these comments. They're very insightful and also super helpful for me in order to move respond to certain concerns that were raised and that I had myself. So thanks a lot, Hailim, for pointing these tips and advice out to me. I'll definitely follow through with them. Thanks a lot.
Yeah. Okay. So I had a couple of questions. I think like you gave this paper at Rutgers a while ago, and I might have asked them before. So your paper's about the 1920s, and I think it's great. But now here's the thing. So the money markets were not fully integrated at that time. There's a lot of evidence to that effect. And so given that you do not have sort of perfect arbitrage across interest rates across all of the United States, that in a sense you can do this kind of policy. You can do this kind of experiment because contractionary monetary policy in one district will have spillover effects, but not enough to sort of weaken the initial effects on the district. So then when you carry the analogy forward to today, which is what you're trying to do for policy, there's pretty well full integration. So it's like, and so I understand it's an experiment, but you have to be careful. That's my first question. The second one is about stigma. So back then, there wasn't any stigma, so they could do exactly what you said. Okay, but what happens later in the 20s is the Fed doesn't like the fact that banks are borrowing and then relending, and so they introduce stigma, and they tell banks that they should only lend when they're really in need. And of course, this becomes a huge problem in the Great Depression, and becomes a huge problem with lender of last resort policy all the way up to Dodd-Frank. Okay, so I just wondered if you could maybe react to those two thoughts.
Okay, so external validity is definitely always an issue when you have these sort of experiments, right? So the one thing that I try to be really careful about that as much as I can, and it's like sort of the optimal, as you say, it's sort of the optimal conditions in a way to test what the pure effect of these policies is, whether this can be replicated in a modern setting. I'm skeptical about that too. I think one thing why it's still interesting for today is because, as I said, it can be a source of at least a source of inspiration in terms of how you design policies or what kind of options are still out there, and what hasn't been used, even though there might be different contexts now. And also because and one reason why I mentioned this specifically is because there's this experience with the ECB, but there's also more generally reserve requirements are used a lot by emerging market economies nowadays. In this case, it's more of a quantitative lever that they use. So they impose a certain minimum requirement or so in order to counteract the boom, for example, or they increase the minimum requirement. In this case, it's what this paper shows is that you could also do it via the cost, essentially, of reserves. So it's sort of an I think it's still an interesting event or episode to inform policy considerations nowadays, even though there might be conditions might be more difficult to handle in modern settings. The second point with regard to the stigma and I think also moral suasion, from using the discount window and so forth, that's true. Yeah, it's something that speaks to the same point of external validity. So perhaps it's one thing that one can one thing that could be argued is that it might not be feasible to implement that in the context of the Federal Reserve, but it might well be possible to implement that in the context of another central bank where this kind of problem does not exist so much. But it's a point well taken, right? I want to be as careful as possible talking about external validity here, and are claiming that we have that always.
Okay.
So thanks a lot for these comments.
Okay, thank you very much. So let's turn to Melis, the next speaker. So you could share your slides, Melis.
Yes. Okay, here we are. So you should be able to see my slide now. Yeah, okay, thank you. So thanks a lot for having me to this great session. So today I'm presenting this paper on some international currency, the pound sterling. So the international currency are important instrument of the international monetary system. They are used for cross-border payment, international capital flows, and there is a debate about the future of the dollar, because it was the main international currency for the last 50 years, but then its monopoly has been recently contested. So first, the introduction of the euro created a decrease of the importance of the dollar for international payment. And these days there are new contenders, such as the renminbi, or even crypto assets such as a Bitcoin or Facebook DM could become important payment for international flows. And so my contribution to this debate on the international currency future is to offer a new case of a zombie international currency. And I study more specifically the pound sterling after World War II. And to do so, I have new data. And so I observe sterling holdings in Commonwealth countries and in Western European countries after the war. And I show that the shift away from sterling was done very early on in Europe, contrary to the Commonwealth country. And so I provide a new narrative on the international role of sterling, and I call sterling a zombie international currency. Why? Because I show that the United Kingdom lacked the economic fundamentals to support the international role of sterling, and that each time a central bank could divest outside of sterling, they did. And so I show that the international circulation of sterling was artificial because British authorities used propaganda, threats, and sanctions against Commonwealth countries to limit divestment outside of sterling and into dollar. So I argue that the sterling area was a captive market, so we shouldn't consider sterling as a true international currency after the war, but as a zombie currency. And so this result challenges the possibility of a multipolar monetary world based on the Bretton Woods experience, which is one of the possibilities for the current international monetary system discussed this day, where we would have the euro next to the dollar, next to the renminbi. And so I argue that the Bretton Woods period was mostly a dollar world. So what are the debates around this question to which I contribute? So first, there is this debate about the possibility or not of having a multipolar currency world. And so the old view was that international currency tend to work as a monopoly market. So one currency would become the dominant instrument and would fulfill all the functions. But then Green and his co-author have argued that the multipolar monetary world would be possible, and they notably rely on the case of the Bretton Woods era, so the period from 1945 to 1971 as an example of such a multipolar monetary world. And they argue that this period was characterized by a gradual decline of sterling and an increase of the importance of the dollar. So the second debate is focused on this decline of the sterling and trying to precise the time of the collapse of sterling as an international currency. And so some, such as Again and Flandreau, argue that sterling was already dead during the interwar, and the shift from sterling to dollar happened during the interwar period. And others, such as Catherine Schenk, argue that sterling remained a very important international currency until the devaluation of 67 and the 70s. And then there is this maybe reconciliating view that the sterling had only a regional role during the Bretton Woods era. And so the issue is that so far, researchers had only access to globally aggregated foreign exchange reserves. And so this is the data people used to work with on the right. And so you see here this gradual decline of sterling at the world level and the gradual increase of dollar as a share of world foreign exchange reserves. And so I contribute to this debate by building country level currency composition of foreign exchange reserves. And so the regional role of sterling would be that sterling was only used in the sterling area, which are the dark blue countries in the map here. And so this area was composed mostly of Commonwealth countries, with the exception of Canada. And so on this regional role, there is also a debate on why this country kept using sterling and not switched to dollar, which was the key currency of the Bretton Woods system. And so Catherine Schenk argued that there was a collective interest in managing the retreat of an international currency. And others, such as Susan Strange, argued that there were inducements. And so it was a perceived national self-interest that made this country keep using sterling as a reserve instrument. And finally, a few others argued that capital and exchange control played a role in the use of sterling in this region. And so, as I mentioned, I contribute to all this debate first by providing new data at country level. And so to do so, I visited archives in European central banks. So I have a panel data set of 9 European central banks for which I have the share of sterling in reserves. And I complement this data with a sample of sterling area country. So I have most of the sterling area. My sample represents on average 70% of sterling liabilities held in this region. And I use this data. I build this data based on archives in the UK and in international organizations. And so thanks to this new data, I'm able to reconstruct the share of sterling within the foreign exchange portfolio for my 2 groups of countries, so Western Europe and the sterling area. And so this is what the results look like, and we see it's very heterogeneous across these 2 groups of countries. In Europe, sterling doesn't represent at all an important part of the foreign exchange portfolios. It represents less than 10% for most of the period, otherwise it's the majority asset in the sterling area portfolios. And the main question then is to explain why such heterogeneity and why sterling area country kept the majority of the reserves in sterling and not into dollar, which was the key currency. And so if we turn to the theory of international currency, we learn that there are 4 key elements that determine the reserve currency status of a currency. And so the first is the economic size of the issuer country. So here would be the economic size of the UK, its credibility in facing financial markets, its financial debt, and the strength of its trade network. But if we look at the UK after the war, we don't find most of these elements. Why? Because the UK is really affected by World War II. After the war, it was a world largest debtor with a ratio of debt to GDP as high as 200%. And most of this war debt was actually held as in sterling. We call them the sterling balance. It's a war debt held mostly in the sterling area. And so these liabilities really put pressure on the Treasury and the Bank of England. And so the UK had to devalue twice during this period and had to restrict current account convertibility for all its partners until 58. In addition, it faced recurring deficit and rising yields, showing not such a strong credibility toward markets. In addition, the UK didn't have a good economic performance. It had a slower growth than most of its European partners, and it has a declining share in world trade and persistent trade deficit that weighted on the Bank of England reserves. So we don't find here the key elements that could foster a reserve currency status for sterling. And so one variable that could actually explain why sterling remain important in the sterling area would be the bilateral trade. And so a relation between the sterling area country and the UK market would foster the use of sterling within the foreign exchange portfolio. And so to investigate this dimension, I run an empirical exercise. So I use as dependent variable the share of sterling in a central bank reserve portfolio, and I use as explanatory variable the whole of the bilateral trade, and I control for sterling area membership and relative GDP size and usual gravity controls such as weighted distance, and I include the year fixed effect and a control for colonies. And so my results are actually pointing toward a very strong sterling area effect, which is coherent with the graphical evidence. And so, but what is really interesting in here is to see that sterling holdings in the sterling area members country were less reactive to variation in bilateral trade. So if you see the coefficient for trade intensity with the UK, it's positive for European countries. But if we look at the one for sterling area membership, it's a sum of 0.13 plus -8, and so it's smaller, meaning that the reserve composition of Australia was less reactive to change in bilateral trade than the one of France, for example. And so this is puzzling, according to the main theory of international reserves. And in addition, what is really interesting to note is that a growing size of a sterling area country was associated with the diversification of the reserves away from sterling. And so I explained this result by arguing that the sterling area should be understood as a captive market. Why? It's because the UK built a very strong exchange control fence around the sterling area. And so the members of this area were not free to convert their sterling balance that they had since the war into dollar. And so each of the movements of their sterling toward a country outside of the sterling area had to be agreed by London. In addition, they were forced to pool their dollar and gold in London at the Bank of England. They were not free for most of the period to keep them for themselves. So within this area, using sterling as a main foreign exchange asset was the condition for the membership, and the diversification of reserves without explicit consent from British authority meant leaving the area. And so how did the UK manage to make this captive market work? They offer few inducements, such as an easier access to London capital market and some preferential trade policy that accredited from the interwar period that they managed to continue toward this during the Bretton Woods era. But I argue that the main force that explained the continuation of this captive market for the period is a systematic threat from the British of commercial and exchange control sanction toward countries that consider a potential diversification of the reserves. And these threats include harder exchange control barrier, cutting free flow of private capital from the UK toward the sterling area members, a limited borrowing capacity for a member of the area in London, and then because all the country had pooled their gold and dollar assets in London, if a country were to leave the area, then the London would cut access to the central gold and dollar reserve at the Bank of England. And so these threats actually weighted a lot on the currency. And so if we look at the period and the dynamics of the area, we can understand the process as a prisoner dilemma, in which at the beginning of the period, sterling area members cooperate. So they keep most of the reserve in sterling, they keep a sterling balance, and they cooperate by guaranteeing or protecting the value of this reserve by not devaluing. And so early on, we see some defection, and the first one is Egypt. Egypt was one of the largest holders of sterling after the war, and they wanted to diversify the reserves because they wanted to acquire dollar to finance their development, and the UK really resented the application and the demand, and so they decided to expel Egypt from the sterling area and freeze all of their assets in London, which resulted into an exchange crisis in Egypt. So the convertibility was blocked, and this created a huge impression on sterling area members, forcing them to, or strongly pushing them into respecting the rules and cooperating. One country managed to reduce its sterling holdings, it's South Africa. And why? Because they made a deal in which each time they would convert sterling into dollar, they would send gold from the mines to London to the Bank of England. They will sell gold. And so this explains why South Africa managed to stay in the area while reducing its share of sterling. And then a few other countries left the area, Iraq in 58 and Burma in 66, both because they wanted to diversify their reserves and acquire more dollar. The UK refused to let them do, so the country decided to walk out and face a sanction, but because they had a more diversified trade network, the sanctions were not too harsh on them. But then in 67, the UK devaluates, and that created a huge blow because it's a 14% devaluation. And so there is a massive move for selling sterling and transferring from sterling, the reserve from sterling to our dollar from the part of the sterling area members. And so to prevent this massive transfer from sterling to dollar, which would have created maybe a second devaluation of sterling in the early months of 68, the UK, forced by the G10, decided to offer a protection of the dollar value of the reserves in exchange of a freeze of the sterling reserves. So basically, after 68, the sterling held in sterling area is frozen. And so what was the gain for the UK of such a captive market and all these capital control rules and negotiation? And so I argue, actually using the words of some Bank of England official, that the sterling area can be seen as a bank with insufficient assets to meet its liabilities. So the liabilities are here, this huge war debt, and the Bank of England has not enough assets to meet its liabilities. And so the area worked as a mechanism to restrict sterling convertibility into dollar and gold when British reserves were low. And this allowed for devaluation of the pound and devaluation of the adjustment that should have been made after the war. And so I argue that because of this, we should think of the UK, of the Bank of England as a zombie bank, and the UK and the sterling as a zombie international currency. And so to conclude, this paper I provide a new view of the role of sterling in the international monetary system after the war, arguing that it was not international reserve currency outside of the sterling area because European country resorted or used mostly dollar other reserves. And actually we should think of sterling as a zombie international currency because the UK had poor macroeconomic fundamentals and increasingly relied on international liquidity to face a confidence crisis, and only exchange control and threats of commercial sanctions delayed a devaluation of sterling. So we should think of the sterling area not as a free monetary union, but as a captive market. And so the regional role of sterling after the war was artificial, relying on high switching out costs, discouraging defection. And so Bretton Woods should not be thought as a multipolar monetary world, but a dollar world in which zombie international currency managed to survive thanks to coercive diplomacy. Okay. Thank you very much for your attention.
Okay, so it's me. Okay, so it's a great paper. Next slide. It's a great paper. It presents a major revision of the conventional view on the role of sterling in the Bretton Woods system and the problem of sterling balances. It challenges the views of Catherine Schenck and others who saw sterling's persistence as a reserve currency in the post-war as reflecting continued value to its holders as an example of successful international cooperation, or at least as a result of a holding operation by the US and the international financial institutions. So what Mela shows is that the pound only prevailed as an international reserve currency because the UK pressured its colonies and former colonies to hold it when it was really against their long-run interests. Next slide. The sterling area countries kept large balances until 1968, whereas the European countries, which were not under the UK's political sway, they bailed out of sterling in the 1950s because they saw the writing on the wall. So in a sense, I see she views the post-World War II sterling area as a club. In the Groucho Marx sense of the term, I would never join any club that would have me. So she presents very convincing evidence from the archives on how a number of colonies and ex-colonies were pressured into retaining sterling as reserves by the threat of exchange controls, trade barriers, shaming by expulsion, etc. Next slide. Yeah. In a sense, you can interpret it how the British monetary authorities viewed both the sterling area and the Commonwealth or the Empire as a London's gentleman club. As a member, you get prestige and access to a great network of prominent people, but you can only leave when you die or you can't afford the dues. And if you break the rules, you get expelled and blackballed. So I think that analogy might have some relevance. And I belong to one of those and I know about this. Okay, so a key contribution of the paper is its excellent archival research to provide new evidence from the central banks of the European countries back to the 1950s, finding annual data on the composition of international reserves. This is important. I worked in this field and we didn't have the data. So this is a very big deal. She documents the experiences of a number of colonies and ex-colonies and how they were pressured by the British authorities and the views of key British officials on how they would keep the club members in line. Next slide. Yeah. So a suggestion for improvement or further work could be to relate the experience of the sterling area countries in trying to diversify their reserves and reducing their sterling exposure directly to the collapse of the British Empire. So she'd start the story with India in 1947, Israel in 1948, etc. And it's like a snowball rolling down a hill. There are these next network externalities are the key thing, and each exiting member likely learned from the previous successful experience with the successful exiters. So getting rid of sterling is just part of the story of the devolution of the empire. Next slide. Yeah. So then I wanted to talk about something I've always been interested in, which is the implications for the Bretton Woods system. And a key question in the story of the collapse of the Bretton Woods system was, why did the US prop up sterling? And my answer has always been that sterling was the first line of defense for the dollar. What Melis's evidence seems to show is that the US is propping up a Potemkin village instead of a major economic power. And the historians know what I mean by a Potemkin village. Catherine the Great, when some prominent visitors from Europe were coming to St. Petersburg, they built a fake sort of facade of a modern 18th century US city. That's UK British city. If instead of wasting valuable resources in all of the large rescues of the 60s, the US monetary authority should have concentrated more in putting its own house in order. In other words, following stable monetary policy to preserve the gold dollar system. Next slide. So there are a number of problems. I can't just go on and praise this thing. So there are a number of issues here, mainly in the conclusion. I really like what she did in the paper, but the conclusion is not as good, or excuse me, it needs some improvement. So she says that the Bank of England was crippled by war debts, but the Bank of England wasn't crippled by war debts. The Bank of England wasn't independent. It's the British government, and especially the Treasury, which has responsibility for the war debt. And then she argues that having an international lender of last resort could have solved the sterling problem. It could have hypothetically dealt with international currency crisis, like the sterling crises that occurred in the 60s, but it couldn't have dealt with a structurally flawed system. Next slide. I mean, the war debt wasn't a monetary issue. It was a real issue that the British borrowed heavily from the US and Canada to fight World War II. And what was needed was something else, an international debt resolution mechanism like the Dawes Plan or the Young Plan in the interwar, or the Brady Plan for Latin America in the 70s. And finally, why would the US, and this is an old one, why would the US and others give up monetary sovereignty for an international lender of last resort to bail out the UK from the consequences of its own bad choices? Another point is she says that the English monetary policy was not credible in the money markets, and the Bank of England had to devalue twice. Next slide. Well, it wasn't the Bank of England, but the Treasury and successive UK governments that's the problem, leading to a collapse of credibility in the 50s and 60s. It was expansionary fiscal policy accommodated by a passive central bank. And that was based on the belief that expansionary aggregate demand policies could raise the trend growth rate. And another point here is that the treatment of the Suez crisis, I think that needs to be fixed up a little bit. What happened was it was the US government, the Eisenhower administration, torpedoed the Suez operation. They were opposed to this because they were opposed to the British Empire and the French Empire. They wanted to break them up. So it pressured the IMF to deny funding for the current account deficits of Britain and France. And that's what happened. Okay, next slide. Okay, so that's, I think it's a great paper. And, I think it's going to do very well. Okay, so we have a couple of minutes. Are there any questions anywhere? Let's see. We don't have any Q&A. Do you want to respond? Melis, yeah.
Thank you very much for your careful reading. I really appreciate it. I think you're totally right for the Bank of England versus Treasury. I think I tend to be a little imprecise here. Bank of England was indeed, as you said, not independent. And so the key decisions were taken at the treasury level, and then the Bank of England not really a choice but to implement them. So yeah, for sure, the valuation were mainly led by the Bank of England. I think your point on the Suez crisis, I think it's really interesting because it's a moment where, because in the late 40s, the US accepted the prolongation of the imperial preference within the Commonwealth and the sterling area, because they saw this as a mechanism to hold the empire together and avoid the defection of some countries toward the Eastern Bloc. But then this support to the empire maybe reached the limits at the Suez crisis. I think it's a really interesting moment. And definitely sterling at the first line of defense to the dollar. It's what happened in the mid 60s when sterling faced several confidence crises, and then the US comes and offers a liquidity line to the Bank of England to answer to the attacks. Then the reasoning is that the devaluation of sterling would then prompt markets to then speculate against the dollar, which is what happened in 67, 68. So yeah, that's for sure. Thank you for your comments.
Thank you. So let's turn to Victor's paper, please.
Can you all see my slide? Yeah.
Yeah.
Yes.
So thanks a lot for having me. I will start by apologizing because I'm a bit sick. Hopefully it's not COVID, so I will try to get myself understood as clearly as possible. So this is the first chapter of my PhD, Public Credit and the International Transmission of Monetary Policy. So first, what is public credit? What is it that I call public credit? Well, public credit is the credit extended by state-owned institutions with a public mandate. So there's two important things here. First thing is that these institutions are owned by the state. Second thing is that they have a public mandate, meaning that they're basically policy tools used by the state. I will come back to this in a minute and be more precise so we can clarify what are public financial intermediaries and how I identify them. So this article puts together the first long-run data set on public credit. The data set covers a sample of 6 countries: France, Germany, Italy, Japan, Norway, and the US. Quarterly frequency over 70 years, so 1960 to 2020. Let me quickly say that this is a very preliminary version of the data set. I'm currently including roughly 15 other countries, mainly developing countries. And again, I will see why in a minute. So 3 main results stand out. First, public credit generally accounts for a large share of total credit, right? It's not just historical curiosity. Of course, it's interesting from a historical point of view. That's why I'm here. but it's not just a detail, right? It's 26% of total credit on average in the 6 countries in my sample between 1950 and 1995. Second thing, and I think that's one of the reasons macroeconomists choose to dismiss public credit or tend to neglect public credit, is that public credit is not just a synonym of financial repression. Public credit did not exist only when the capital account was closed and when the banking system was tightly regulated, right? Public credit tended to persist outside areas of financial repression. That's what's key about it. It existed in transition economies, in mixed economies. I'm going to emphasize this point in the presentation. Last thing, local projections reveal that public credit is not sensitive to foreign monetary shock. Again, this is a preliminary result. I just try to look at the basic properties, macroeconomic properties of public credit. And I do that by looking through the lenses of the trilemma, and I show that public credit markets are basically impervious to US monetary shock. And this has important insight for other categories of models than the trilemma. So let me say a bit more about the data. Previously, the only available estimates of public credits were from Verdier and Beck et al. Verdier only gives point estimates, it's not really serious, and Beck and co-authors, they just focus on the tip of the iceberg, so to speak, of public credit. They just focus on state banks. But as we're going to see, state banks is just one type of public institution out of many, so I'm going to explain this in a minute. So how does public credit relate to existing long-run series of credits? So existing long-run series of credits are generally drawn from the IMF, so that's Dembiamont and co-authors, from the IMF, from the BIS, sorry, BIS, Dembiamont and co-authors, the IMF, Monet and Puy, or from the Jordan and Schuler database. In the public financial intermediaries, they're overwhelmingly excluded from this database. And the reason for this is that the IMF, the BIS, and central banks, they define bank as institutions that have short-term liabilities, and this effectively excludes most public intermediaries. There's some exceptions to this. I will present a few in a minute. There are some exceptions, but public financial intermediaries are overwhelmingly excluded from series of private credit because they're not banks and they're not considered as banks by central banks or by the BIS or by the IMF. They're not considered as banks, so they're excluded from series on loans by the banking system. So public credit is basically absent from empirical works on credit. So that's a key issue, especially because it tends to have different macroeconomic properties in private credit. So what I do here, again, as I was saying, is that I start examining the properties of public credit by looking through the lenses of the trilemma. This is a very preliminary way of looking at it. Of course, we would like to see the reaction to other types of shock, uncertainty shocks, to financial crisis in the vein of Shulart and Taylor, but this is just the first step, of course. And what I show here is that public credit markets are essentially impervious to US market shock. This should not come as a surprise to people who study the political economy of public credit level. I will explain in a minute. So let me say a bit more about public credit itself. So public credit is granted through a large variety of institutions, government agencies, especially in the US, public funds, specialized credit institutes, development banks. So development banks, that's the main type we usually think about, is just one type out of many. We emphasize this again. So these institutions, they share some common characteristics, and I choose to highlight these three characteristics in particular. First thing is that they share a mandate from the state to fulfill certain public policy objectives. So again, they're used as tool by the states to fulfill economic policies. So the state chooses to step in the credit markets. It does so through public intermediaries. So they generally tend to focus on the same economic sectors: housing, agriculture, export industries, small and medium. We could add student loans to this list, especially in the US. So these are all economically or politically vulnerable sectors. These are all sectors for which private finance is either unavailable or available on terms that are not considered consistent with the state's developmental, economic, or public policy goals. So that's why these public financial intermediaries, they're set up to make up for some kind of market failure, right? And they tend to provide cheap loans. Well, they do. They provide loans at below market interest rate, and these interest rates are also more stable. They tend to be more stable than private rates. I'm going to try to show some details on this. So how did I went about collecting this data? Well, my main data source are historical statistical reports by central banks, central bank archive, and occasionally internal database of central banks. So data that was collected by central banks and not shared with the public, and that they managed to access after long and tedious negotiation. Well, that's a bit harsh of me because they did share the data. Anyway, the two important things about how I collected the data. First thing is that in each of these sources, systematically, public intermediaries are distinguished from private intermediaries, and they're distinguished from the banking sector. That's very, very important. I didn't select public intermediaries based on my own assessment. The selection was already done by the central bank. They were already grouped in a single category that's sometimes labeled the public financial institutions, state banks, development institutions. That depends on the country. But they're already grouped in a single category, and this category is not presented in the same section as loans by the banking sector, and that's absolutely crucial because banking sector loans is the loans that are used in every single long-run data set that is available, right? By the BIS, by the IMF, by the Jordan Shulart database. They use loans by the banking sector, which basically aggregates loans by commercial banks and a bunch of few other intermediaries that have short-term liabilities. That excludes most public financial intermediaries, not all of them. I'm going to say more in a minute. And importantly, nationalized commercial banks are not included in the series of public credit because the central bank obviously do not consider them as being tools, as being policy tools, right? They're not considered as being policy tools. So that's quite obvious from the source. Anyway, let's have a first look at the data, a quick look at the data. So this shows public credit in percentage of total credit 1950 to 2020 for the 6 countries of my database. So total credit is calculated as the sum of public and private credit. So two first things to say: for France and Italy, you obviously see a gap after 1994. This is due to a reform of the financial system, and the central bank stopped collecting data on public intermediaries. I'm currently filling the gap, but it's quite it's a bit tricky. So I don't have a series yet. What I have are rough estimates. So France, the line the share is roughly stable until the early 2000s, then it drops quite significantly, and today it's around 10%. So you can visualize it with this estimate. In Italy, the drop is quite brutal in the 1990s. So the drop is quite brutal, and today it's around 10%. But in France, it's quite stable around the mid to late 2000s. Second thing, in Germany, the estimates underestimate the share of public credit because one important category of public banks, which are lenders banks, they're also included in the category in the series of private credit. That's one of the exceptions I was referring to earlier. So I'm currently trying to clean the series of private credits, but I haven't done that yet. So this estimate is probably like 5 to 10 percentage points below the true value. What we can also say is that, except in the US, public credit historically represented a large share of total credit. And it was not only high during the post-war period, it tended to stay high long after. So just some basic notions. So public credit and financial repression. So as I was saying earlier, one of the reasons why public credit has been neglected by macroeconomists is that they just thought that it was a synonym of financial repression. Right? Why worry about studying the dynamics of public credit when it only appears in economies that are basically controlled by the state, in economies where the capital account is closed, and in economies where the economy is basically public? Why bother? Well, this is a gross exaggeration, right? It is true that public credit emerged as part of the financial repression package, but as we see here, it tended to stay stable long after the 1950s, 1960s, and in most countries, it stayed stable until the 2000s, right? So that's a gross exaggeration. So my focus will be on these periods when the state begins to loosen up its control of the domestic economy. The capital account starts to open up. There's capital flows coming in, capital flows coming out. There's a private banking sector, a private financial sector, and public credit is still important. So that's my focus is going to be on these gray transition periods between financial repression and financial liberalization. That's from a macroeconomic perspective. That's when public credit is important, right? So this is the case in many developing countries. That's why I'm adding developing countries in the day-to-day. Indonesia, Malaysia, Mexico, Korea, countries like this. So I'm running out of time a bit, but here I'm just comparing quickly the share of public credit in total credit with the capital control index, which is extremely relevant when we study the trilemma. And just to remind everyone, of course, I'm sure many of you are aware that the first opening of the capital account in France, Italy, and Germany dates from the late 1950s to early 1960s. Of course, in France and Italy, it was not immediately perfectly open. But still, this is the transition period I'm talking about, right? There's some capital controls, some controls in the banking system, but still, there's a private banking system, there's offshore deposits. So this is kind of the gray area I'm talking about. For Japan and Norway, it occurred a bit later in the late 1980s and late 1980s and early 1990s. Anyway. So what do? At this preliminary stage, I compare the reaction of public and private credit to US policy shock, and I use the measure of Romer and Romer, which was extended by year and Agripino. I restrict my sample to the subpopulation of open pegs. Why do I do that? Well, these are countries for which the interest rate pass-through is supposed to be significant. In other words, these are countries for which private credit is supposed to be very sensitive to what's going on in the US, right? And this effectively excludes periods of intense financial repression, most of the 1950s in Germany, the pre-1985 period in Japan. So effectively, I'm focusing on part of the sample that's the transition economies, mixed economies. That's what I'm focusing on. I'm using local projections, and really there's nothing new about equation one. There's nothing new. I just replicate the equation used by Jordan et al., for example. The only new thing is that I calculate the difference between the growth rate of private and public credit, which is my response variable here. So again, it's the difference between growth rate of private and public credit. And I examine its response to US policy shock I. So the specification includes lags of every variable, including the response variable. And I examine the response for up to 8 quarters after the shock. And obviously, I'm expecting a decrease in R following a US policy shock because the growth rate of private credit would be more affected than the growth rate of public credit. That's my hypothesis. And we do see that this is the case, especially in the short run, between 1 and 4 quarters. It tends to be significant, although not really, not a lot significant until 6 quarters. But we do see, especially in the short run, that the difference between the growth rate of private and public credit decreases following a US policy shock. Then I try to confirm this result using the ratio of private to public credit. So again, the intuition is the same. we should see a decrease in the ratio because the effect is stronger on private than on public credit. And it's even more significant, right? The magnitude here is 4 to 5 times larger, especially in the short run, but it's still significant after 7 and 8 quarters into the shock. So these are very preliminary results. I don't deny this, but it's still a hint at the fact that public credit might be interesting for not only for trilemma and dilemma models. It might have some interesting macroeconomic properties that all models featuring a strong procyclical role for credit might be interesting. So this result obviously should not be surprising for people who studied the political economy of public credit. Why? These people probably know that the interest rate on public loans are generally more stable than private interest rate. If I have time, I will show you some details on this. So public credit markets are not really sensitive to the interest rate channel of international monetary policy transmission. Same with the credit channel. The credit channel was coined by Bernanke and Gettler. It's the idea that an increase in the Fed's rate causes a deterioration of borrowers' balance sheets and makes it harder for them to borrow. Well, public intermediaries, they're designed to assist borrowers that are struggling to borrow because of their balance sheet. Right? They're designed to assist borrowers with inadequate collateral, low net worth, like student, for example. Being a student myself, I know what it's like to be turned off from private finance. Right? So they're designed to assist borrowers with inadequate collateral. So we can assume that the credit channel is not very efficient in public credit markets. The risk-taking channel, again, is the idea that monetary policy affects the willingness of market participants to take risk and their perception of risk. Well, public intermediaries, they do not deal with risk the same way as private intermediaries because they do not have the same incentive, because they're public. And that echoes the critics of public credit who say that they don't have any incentive. Right? Their losses are absorbed by the state. They are not rewarded for extending more. So I'm running out of time, so I'll actually wrap it up. So 3 main results are put forward. First, public credit generally accounts for a large share of total credit, right? Remember the statistic at the beginning, 26% on average to 1995. Second, public credit is not systematically associated with a repressed financial system, and that is absolutely key. And C, public credit markets are relatively immune to this market shock. So from a macroeconomic perspective, what I'm saying is particularly important in the transition between financial repression and financial liberalization, right? In some kind of mixed economy where the state still retains control on the economy, but there's a relatively open capital account, there's a private banking system, there are offshore deposits, stuff like this. So these are economies where macroeconomic theory applies, right? So what next? Obviously, include developing countries today. That's what I'm doing. I'm currently including 15 other countries, well, a bit more than 15 other countries to the database, mainly developing countries, and considering other type of shock, financial crisis, uncertainty shocks. Because as I was saying, we should keep in mind that public credit, the properties of public credit are not only relevant for trilemma and dilemma models, they're relevant for all types of model with a strong procyclical role for credit, right? Well, that's about it. I think I exceeded a bit. So, looking forward to your comments. Yeah.
Okay, so it's Bjorn.
Yes. Let me share my slides. Okay. You see my slides? Yes. Yeah, thanks a lot for giving me the opportunity to discuss the paper. I think Victor did a great job in explaining the main results. So let me just jump right into it and try to summarize. So I would interpret, I think it's fair to say that it's still very much work in progress, especially the data set. But I think it's a very great idea. I'm really looking forward to this data set. So basically, the idea is to construct a data set on public credit, where public credit is defined as credit extended by state-owned institutions that have a public mandate. And then normally what happens is that these loans extended by these institutions will be subsidized in some way, meaning that the interest rate will be below market rates. And this will happen according to some government objectives that, yeah, we don't know here, but may relate to the support for some industries at the moment, maybe green industries or something like that. And what Victor is finding is that, first of all, public credit is important. So it's 26% of total credit in his current sample. And this is irrespective of the degree or seems unrelated to the degree of financial liberalization, or at least it still plays an important role even today. And then in the second part of the paper, he basically looks at the exposure to the global financial cycle. And he has two findings in the paper. He only presented one here. So the first finding is that public and private credit markets are differently affected by foreign monetary policy shocks. And the second one is that the dependence on public credit also matters for the output consequences of foreign monetary policy shocks. And let me just, so I have three main comments. Let me start with the data. I think this is a very difficult task to define public credit. There's huge heterogeneity across countries in terms of institutions that are doing this. At the moment, the definition seems to be that there must be some public mandate. And Victor was talking about how to treat, in the German case, for example, Landesbanken. I think it's very difficult to make these choices. And I would just, I have no solution for you. But from being from Germany, I can tell you that savings banks, for example, are governed in a very similar way as Landesbanken. Actually, the savings banks often own the Landesbanken. And the savings banks also have a public mandate. So I'm just saying you should be really careful to exactly specify your definition of what is a public bank. And I think I would, based on my experience with this kind of data, I would stick to what maybe central banks are doing when they are publishing this data, because otherwise it gets really difficult. And then the second concern I may have about the data is that state intervention in credit markets can take many forms. And it's not only that state-owned banks give credit, but what we see, for example, now with the COVID crisis is that the state guarantees for credit given out by commercial banks. So this is the response in many European countries. In Spain, for example, I know that basically the government is guaranteeing for loans extended by commercial banks. And it's very difficult because these guarantees may not even show up in the balance sheet. So it's very difficult to account for this. Again, just something to remember and think about when creating these series. And what I was interested in, and I don't know whether you talk or I didn't understand it in the talk. Do you have information on the borrowers? And in particular, is the series defined based on lending to households and firms? Because that is the different kind of definition usually applied in these other data sources. And I just became interested in this because I'm currently working with financial accounts data. And what I'm showing you here is the data, the financial accounts of the Spanish general government. And in light blue on the top, you see the assets that are loans by the Spanish government. And you see that this series, I mean, it looks small here, but it's going up to almost 20% of GDP. And I was just interested whether something like this would be included in your data, or whether this is lending by the Spanish government to other entities than households and firms, and as a result would not show up in the data. Again, just something to think about when creating these data series, and to be careful what to include and what not to include. Then regarding your preliminary results, I would say I have two comments. So the first result I think is quite intriguing, that the foreign monetary policy shocks do not affect public credit. And I would maybe not show always the difference between public and private credit, but also show them separately, because what could be interesting is whether public credit is actually acting counter-cyclically. So is the government trying to set off the foreign monetary policy shock by lending more, or is it just the private banks decreasing their lending as a response to this shock? So it would be interesting, because it also would help us to interpret the behavior of these public banks a bit better, because maybe they are just there to set off some shocks, or maybe they are just giving out a stable amount of credit over the business cycle. and not reacting to the cycle at all. The second result, and you didn't present it here, so let me be very brief. I'm not super convinced because, yeah, theoretically I didn't see the point, and then that it's not totally clear that it should be that higher public credit provides some insulation from foreign shocks. And also the results were not as clear to me as you maybe interpreted them. And then let me just highlight some further points that I had while reading the paper. So first of all, I was a bit surprised by the stability of the series as a share of total credit in many countries. So this is despite a large increase in credit to GDP ratios in most countries. So this means the state or public credit also increased. It increased at the same rate as private credit. And then especially, it seems not to be very counter-cyclically in the sense that we saw some big credit cycles in the second half of the 20th century and more recently. And this doesn't show up in the share of public credit. So as a result, it seems like there's not too much difference between private and public credit here. I think that for future work, you're probably thinking about this already to explore the relationship with subsequent crises and GDP outcomes in line with what the literature on crises and business cycles, especially household credit, the literature where Nian and Sufi are publishing papers, what they are doing. I think this would be super interesting. And then one concern I had, because when I first read the paper, I was reminded of this older literature, this Laporta et al. Papers on state ownership of banks. And it would be good to understand how exactly you relate to this literature, because they had a quite negative view of public lending or state ownership of government ownership of banks. So it would be interesting whether maybe you can just reassess their findings for more advanced economies. Maybe the problems are not the same in your set of countries. So that would be interesting. And then the final point is that intervention in credit markets can take many forms, and it would be good to also think about this in some way. So for example, my colleagues are currently working on the idea that governments actually use procurement contracts to relax financial constraints of firms. So firms can get credit because they have future guaranteed sales in the future. So it would be good to have a more general way of thinking about public credit. Thanks.
Okay. Victor, did you want to respond?
Yeah, very quickly. So thanks a lot for the comments. I agree with most of them. So first thing you said, how do I define public credit was, well, exactly as you said, I rely on the central bank definition, right? I do not make the definition myself. So it's not perfect. There's some, it's the definition, the limit between public and private is not so clear cut. So there's some institutions that may be falling in one of the two categories, and savings banks is a very good example. So, but the best I can do, I think, is rely on what's already been done by the central bank and use it. So that I agree with the comment. Second thing, it's credit to private intermediaries, to firms and households. It does not include public credit to public intermediaries. Yeah, last thing that you said, how do I relate to the literature, Laporta, Schleifer, and everyone? Yeah, that people say that public credit was not allocated efficiently. So I don't deny this. It might be the case that in some countries with bad institutions, public credit is not allocated efficiently, but you should be careful if you want to privatize it, because it has some important stabilizing property. So you should do it slowly, or you should maybe introduce some capital controls at the same time to buffer a bit international shock. So I don't deny this, but you should write the link with this literature should be more explicit. So I agree with most of the comments. And thanks a lot.
Okay. Well, all right. We seem to be pretty well on time. So I don't see any other. Hello? Yeah. Yeah. I don't see any other comments. So why don't we thank you and shift to the next panel. Okay, thank you.
I will share my screen.
So it's Conrad.
Yes. Right. So can everyone see my screen okay?
Yes.
Excellent. Great. So my paper is called Riding the Monsoon. It's basically about geography and Iron Age trade in the Indian Ocean. And it sort of comes out of the research question of, we trade in the ancient world and sort of late antiquity. It's very constrained by technology and high trade costs. And so it makes long distance trade very, very expensive, prohibitively expensive in a lot of cases. And the Indian Ocean was very different in this respect, right? And the geography and the climate conditions of the Indian Ocean made this difference possible. Essentially, the regularity of the monsoon winds and the fact that land masses are sort of in a big horseshoe shape around the ocean, and so you can leave one side and with reasonable certainty end up on the other side at some point in time. And so this is sort of the motivation behind this paper. And so I build a data set of trade in the Indian Ocean from textual sources from the ancient world, namely the Periplus of the Erythraean Sea, and basically calculate and estimate a Ricardian wind augmented gravity model. And then I look at how these trade flows and this trade network influence development and then the persistence of these effects. And so the key results are essentially that the wind matters, right? Geography matters, and that the trade network of the Indian Ocean is well modeled by a wind augmented Ricardian gravity model. And then in terms of development, it's sort of this idea of export-led development, and diversity of exports leads to higher levels of development. And there's also a little bit of evidence for an ancient resource curse, where sort of specialization in cash crops and sort of more plantation-based export goods leads to or is linked to underdevelopment. And then there is some persistence of these effects into the early modern period. And so in the interest of time, I will skip over the literature and go straight into the data. And so the trade data for this, as I said, comes from the Periplus of the Erythraean Sea, which I won't get into a whole lot about what it is. It's basically a first century document that was written by a Greek, likely mariner, who basically outlined the trade relations around the Indian Ocean. And so within the document, there's 150 individual products named, and within 37 product groups, and almost 50 identified cities. And it's actually incredibly comprehensive in sort of how it labels partner cities and links between cities. But there are two sort of gaps in the sense that, it can sometimes say a general region, but it can also sometimes not indicate a partner at all. And so these are challenges to overcome in the data. And so here is a sort of a bar chart that shows sort of the regional breakdown of export baskets, right? And so it is very regionally focused in terms of dominant export groups. And this sort of leads into the endowment effects and sort of the Ricardian nature of trade in the ancient world, and sort of consistent with that. And so the trade variables that I build for this analysis, there's two primary ones. The first is sort of a measure of bilateral trade, which, because of data issues in terms of value and quantity within the Periplus, is the extensive margin. It's the number of goods that are traded between two cities, not necessarily the value or the volume of individual goods. And then for development, we deal with sort of a trade basket diversity measure, which is basically a modified Herfindahl index, which sort of shows the concentration of goods within the export basket, and sort of, how much variety there is within that. And wind speed comes from satellite data and a model of a reconstruction of a square-rigged cargo ship from the Edo period that was done in Japan, and it roughly models what we're sort of expecting from ancient ships that would apply sort of the Indian Ocean. And this is used to calculate basically routes between different cities, within that are named in the Periplus within the different sort of monsoon seasons. This is the summer set of routes. There's a complementary set of winter routes, which I won't show, but to sort of get the idea. But the question is sort of, how does this actually work, right? And sort of, is this the same as what it was then? And so this table compares the calculated distance, basically the time it takes to get between two cities, with the attested time that it takes to get between the two cities in ancient sources, and it's pretty close, right? Like it's pretty reasonable. I'm, not to sort of gloat or whatever, but it's pretty accurate, right? And so it is a good estimation of transport costs in that sense. And so the development bit sort of, I'll speed through this in the interest of time for this bit, because it is just a 0.5 by 0.5 degree grid based on 500-kilometer radius around the cities, which is sort of a standard now in ancient sort of geographic, economic geography. And historical development is measured with the Pleiades data set of ancient archaeological sites, which, it has a whole bunch of things. It has settlements, buildings, polities, cultures, geography. It has mountains and things like that. And so I pare it down to just settlements and buildings and sort of human-made things, so that we're measuring sort of human activity within the areas, right? And so I end up with 6,600 sites of the right type within the right sort of locations, the 500 kilometer radius in the grid cells, and within the date range. And apologies to Melanie and anyone who read the paper, there's a rather egregious typo. The cutoff date is 30 BCE, which coincides with the Roman conquest of Egypt, not 30 CE. And so this sort of, the reason these dates were chosen were essentially, the 30 BCE is the entrance of the Roman sort of market power onto the scene of the Indian Ocean. With the conquest of Egypt, it sort of opens up the maritime route to India directly. And then 640 with the Arab conquest closes it, essentially. And so development is taken as the change in human activity, right? The change in the number of sites in these two periods, right? So the pre 30 BCE and then post up until 640. And it's rather crude, but it sort of gets at what we're sort of looking at, which is essentially, what is the relationship between trade as described in the Roman period in the Periplus with development post that. And that's just sort of site distribution. And then persistence, I deal with Portuguese, Dutch, and English trade stations erected in the 16th through the 18th century. So these are the factories and forts that primarily driven by the spice trade, and that sort of just pre-colonial. So sort of the eve of colonial activity in the region. And there's about 289, almost 300 different trade stations from each of the three countries. And so these will take the place of the Pleiades data as sort of a check on persistence of the impact of export baskets and that sort of thing. And so the gravity estimation, as I said, is sort of a Ricardian adapted Ricardian model. And this does two things. Primarily, it's consistent with the data that I have, in the sense that because I can only measure the number of goods that are traded between two cities, the Ricardian sort of idea that more competitive cities will trade more varieties between each other fits with that sort of element of the data, and so it makes it more consistent with the idea that we're measuring on the extensive market. And then it builds in the size of the city and the distance from the destination impacts this competitive, so sort of a standard gravity sort of assumption. And then the standard gravity estimation is down at the bottom there. And so ultimately, the key part of this table is the coefficient on fast distance. And so it is well modeled by this gravity model trade in the Indian Ocean, as given in the Periplus data. Column 3 is sort of a bit of a horse race inspired by Pascal, where I test whether wind actually matters or not, and from insignificant results, but the wind augmented distance, the fast distance, is more consistent with gravity estimations, and so this wind effect does matter in that sense. One thing that is important to note is that the coefficient of the pure gravity model in column 2 is actually quite small, and for a gravity model. And this sort of comes into the idea of the nonlinearity in the relationship between distance and trade, which is rather pronounced, as you can see in this graph. Particularly for it's very sort of clustered low at the short distance element. And so there's two sort of things that could come into this. And very quickly, they are either sort of omitted data in the sense that, the Greek merchant that wrote the Periplus, he's not too interested in local trade and sort of trade between cities that are close together, because it's mostly in staples and that sort of thing, not high value goods that he'd be, that people would be looking for. And so he omits. And the second is that, there isn't actually that much trade to omit, because it is in the sense that if you have cities that are close together with endowments that are based on geography, you have similar export baskets, and therefore trade will be lower. And so I test this essentially with both, sort of just the proximity variable, in the sense that is it just that these cities are close together, but also a index that measures the similarity of export baskets. And so ultimately it is both, right? You have a little bit of both going on here. But the endowment index, so the similarity in export basket, is a significantly larger effect. So it is driving a lot of this sort of nonlinearity. And so it's that sort of provides a little bit of evidence that it isn't just sort of omission because it's not valuable information. There is actually a reduction in trade due to similarity of baskets, of export baskets. And then the second part of the paper deals with sort of trade and development. And again, this sort of looks at two primary elements in terms of export-driven growth, and then the resource curse. And so the two elements here are, the distance to the ports of Periplus, are, what the proximity to these ancient centers increases or decreases development. And then the impact of the export basket or import basket specifically. So, what these cities are trading and the varieties that they're trading. And then the ancient resource curse looks at essentially the share of the export or import basket that is made up of the three product categories that chosen here, basically manufacturing, spices and incense, which are sort of the cash crop of the ancient world, and bullion or specie, which our friend Pliny deals with. And so we'll look at whether his complaint is founded or not. And essentially, the key here is that distance matters, right? Proximity to the ports matters for development, which is sort of intuitive and understandable, but interesting in the sense that these ports did drive growth or were linked to changes in growth. The export-oriented element of this is also interesting in the sense that having a large number of export goods or a more diverse export basket is linked with increased development. And so and this is sort of paired with the fact that, needing a lot of, or taking in a lot of imports or very diverse set of imports is linked with underdevelopment. And this sort of leads into the resource curse bit, where you have a situation where having manufacturers as part of your export basket or having manufacturers as a larger part of your export basket is linked with positive growth, marginal, but still positive. But more importantly, having spices and other aromatics and resins and that sort of thing, the sort of cash plantation crop, being a larger part of your export basket leads to significant underdevelopment. And so this sort of plays into this idea that these cities that were based primarily on bulk trade in spices and incense were less developed. bullion is significant. And so it sort of comes with this or significant and large. And so it's sort of this Pliny's idea that, he complained, as did many others, of 100 million sesterces going to make the kings of India rich at the expense of Rome, and its extravagant tastes and all that sort of thing. And so, I mean, regardless of the moralizing in his claims, the claim itself seems to be, somewhat accurate in the sense that, cities that imported a lot of specie or bullion or precious metals, they tended to be more developed and have larger levels of development. And so you sort of get this idea that the Roman cash is funding growth to some extent in the Indian Ocean, and there's a whole sort of set of things that can come out of that in terms of lubricating the trade market and everything. And in terms of persistence, because I think I am at time, so I will blow through persistence, and that essentially replaces the Pleiades data with the trade station data. And you get some persistence in the sense that these trade stations tended to be set up close to these ancient ports, and they tended to be set up close to ancient ports with diverse export markets, which sort of fits with the idea of what these trade stations were, right? They were about capturing exports back to Europe. And so the narrative here is that there is some persistence in the endowments of these ports. And in terms of distance, the functioning of these ports. And so that these ports remained relatively or potentially major entrepôts up into the early modern period. And there's some robustness checks at the very end, dealing with product shares instead of growth, and changing the cutoff date down to 3rd century decline instead of the Arab conquest, and changes in sample size. And the results are all robust to these changes. And so in conclusion, there's 30 seconds maybe. In conclusion, that there is essentially that the trade in the Indian Ocean in the late Iron Age is well modeled by a gravity model with the caveats of nonlinearity and wind augmentation. And then that this story of export-led growth with resource curse and the persistence of trade effects from the late Iron Age up into the early modern period exists and it's shown in the data. And so with that, I will hand it over.
Okay, that's great. Thank you. And we'll switch to our discussant, Melanie.
Well, very nice talk. So I will be very brief about my discussion. So it's very nice. I think it's a wonderful contribution to the study of the ancient history. And so the paper basically uses all those ancient texture sources to develop a database of this trade in the Indian Ocean. So both that this is a very precious source that hasn't really been used by economic historians, and also it's an area that is just largely understudied. And I think the paper is mostly on historical development, which I think it is a part that should really be emphasized even more, and is where most of the contribution lies in. And then the main findings, I'll just highlight a few. So one is that it shows evidence for export-led growth, but also some evidence for resource curse, such as having too many cash crops. It seems to be less desirable than having manufactured products. Then there's also some of the indication that there will be some long-term consequences associated with this early development and having more diverse set of the products. So in terms of comments, as I already said, so this is highly original work. I am not aware everyone has done this for that region. And there is a very wonderful data set has been created. So I myself have done something a bit similar with for China. So I use the local gazetteers also to try to understand the specialties and the products. And I think what the authors has is much better than what we have in China, and also of an earlier period. And this is a great contribution, and then congratulations. So, so this is just a picture of the Gulf regions, which I took in February 2019. So as you see, it is also obviously very nice, very suitable for trade. And so I think it's not that surprising in that sense. One of the places that had so much trade in the ancient time. So my main questions or comments are, so first, I think the paper, it needs to be a bit more clear about like where the added value actually is. So right now it emphasizes the model part a lot, but I kind of find that it might have been, I think it would be a bit better if you emphasize like the historical development, or just be clear about what you wanted to achieve with that model. Because maybe it is, no, maybe there's a separate point there somewhere I'm not aware of. But right now it just reads like there is this trade models, and then the paper just shows that this ancient data or the ancient world and seems to fit the model as well. But I guess my question is there any reason to think it doesn't? And then it's also this, in terms of the context, I think it could be a little bit more on this. Maybe it'd be like in the appendix. So right now it just reads like I still don't know a whole lot about the actual trade taking place at the time. Beyond that, this is like, several parties involved, Greeks and Indians. And also the data sources, I think right now you just use one, which is obviously a very good data source. It's like a paraplus of the sea, right? But there should be other sources available. It might not be as complete, but at least you can use it to do some cross-validation. Maybe use some automated methods just to like save your time, and also be more objective. And then also the sample size, this might have not been read completely correctly, but it is not a very big sample, right? And then it's a quite long period. So I kind of wonder how appropriate it is to do some of the more finer analysis, given this, having obviously this, the same number of observations for the same number of years. And then the last part of the longer results, I like it a lot, but I think it needs to be more developed or just not done at all. And also I'm curious about if there's any imprints in the culture and institutions, which could be one of the reasons you see those long-run consequences. I don't know if you know Martin Fiesman's work on like what the agricultural suitability or manufacturing suitability, but there could be many more than just that. I think like engaging in trade of that nature, highly similar to each other, could have some consequences in like the mindsets of the locals even to this day. And the reason I mentioned this is I think those are one of those things that tends to persist compared to some of the other more economic factors. And the other comments, and I mean, it's mostly just on the model. I mean, I guess there's some questions about how good the assumption will be, and assume perfect competition. My understanding is there is more, I think it is more, it is closer to perfect competition than the early modern period. But it might be good to mention this because in a lot of people's minds that the trade was dominated by those bigger monopolies or elites and states, I guess mostly influenced by European history. China, on the other hand, actually does have very similar to, I think, what you described in the paper. And then also, I guess I already mentioned this. And then also just curious about that, how you model, are you trying to model those alternative trade routes? You calculated like the travel times, because there will be some other options available possibly. And such, I mean, I don't know if the Silk Road will be relevant at all for the time period and the region you look at. But there is some chance that I think, you can do something for that the entire area. You can account to other available options to those traders. I think that this is all. Yeah, this is all I have. And thanks a lot for the paper.
Okay, these are great comments too. Would you, Conrad, like to respond?
Sure. Very quickly. Thank you for the comments. And yes, in a lot of those points are very well taken in the sense that they are either things that I have struggled with the paper or things that I'm trying to incorporate into the paper. Particularly the idea of sort of alternative trade routes in the sense that overland routes and sort of doing something similar for overland routes that I've done for sea routes in terms of difficulty of terrain and that sort of thing. sort of how it ties into Silk Roads is sort of, you know, is well, anyway, but yeah. So yeah, thank you.
Yeah, I mean, I don't know anything about this. Okay, really, I don't. I thought this was fascinating. I want to get back to her comment about context. So, I mean, I mean, obviously, maybe you talk a lot about this. What's the context? I mean, this is the Roman Empire. It's the period of the Roman Empire, but what are the non-Roman Empire polities, and what is the state of the world in this period? Is it one of peace, war, great movements? I mean, that is the period of when the Roman Empire collapses, right? So, I mean, is there any discussion of the geopolitics of what's going on?
Yeah, I mean, that's a fair point. It is sort of abstracted from the geopolitics in a sense, and part of that is because there's a lot of diversity in terms of the cities themselves that are named, right? Like some of them are city-states, some of them are, you know, small kingdoms, some of them are part of larger empires and that sort of thing. And so there's a lot of diversity in terms of, you know, the political context of each individual city. And so it's, you know, and that also goes into sort of this other point, I guess, a bit about the perfect competition and elites and kings, right? Is that some of these cities have more centralized control on trade than others. And so it's I mean, it's an interesting avenue to explore, particularly in terms of sort of the resource curse, right? Because you tend to potentially get situations where, you know, cinnamon plantations and you know, incense plantations tend to be controlled by elites and the king and that sort of thing. But other goods and cities that specialize in other goods tend to be maybe a little more free marketish than those ones.
Okay.
So yeah.
Anybody on the panel have any questions? We have about 2 minutes. No. Well, listen, I think this is a great, I mean, it was a very diverse panel. I mean, you know, going the gamut from Bretton Woods to ancient times. But I think they're all really nice papers and great discussion. So thank you very much. And maybe next year we'll be in a real place. Okay, and good luck for the year.
Thank you.
Thank you. And thank you,
Thank
Mike,
you.
for the chair.
It's good to see you.
Thanks, everyone.
Have a good day, everyone.
Bye-bye.